the 8 a.m. trap. If you're still making this mistake, it's only a matter of time before your trading account pays the price. I've been there, and you don't have to make the same mistake. Every morning, a few minutes after London opens, the market does something that looks completely random. Price rips through the high of the night. Every breakout trader on the planet piles in, and then, within 1 or 2 candles, it turns around and walks the other way for the rest of the session. If that has ever happened to you, I want you to hear this clearly. You did not read the chart wrong. You read the wrong part of the chart. That spike is not the move. That spike is the fuel for the move. And once you know what it looks like before it finishes, you stop being the fuel and start being the trade. What you'll walk away with. In this video, I'm giving you one complete setup, start to finish. No indicators, no paid tools, no 50-line checklist, 2 lines on a chart, 1 entry rule, 1 stop rule, 1 target rule, and 2 filters that decide whether you take the trade at all. Specifically, why the market moves towards stop orders instead of toward your beautiful analysis. How to mark the overnight range in about 20 seconds. The exact candle that gives you the entry. Where the stop goes so you don't get clipped by the spread. And how to size the target so a normal win rate still makes money. And here's the part I want you to hold on to. There are 2 filters in this strategy. The first one is obvious, and most people already half do it. The second one is the reason traders who know this setup perfectly still hand their accounts back. I'll show you both, but the second one comes later in the video, so stay with me. The market isn't hunting your level, it's hunting your stop. Start with a simple fact about how orders work. A stop loss is not a wish. It is a live, resting order, sitting at a price, and the moment it is touched, it becomes a market order. Sell stops become market sells. Buy stops become market buys. That means every cluster of stops on the chart is a pool of instant, guaranteed volume. Now ask where those clusters are. Retail traders are taught the same 3 rules. Put your stop under the swing low, above the swing high, or just outside the range. Millions of accounts. The same textbook, the same levels. So the stops don't sit randomly. They stack in tight bands, a few pips beyond the obvious extremes. If you need to fill a large position, that band is the cheapest place on the chart to do it. Everywhere else, you push price against yourself. There, the sellers are handed to you automatically. So the aggressive push through the level isn't conviction, it's shopping. And when the shopping is done, the push has no reason to continue. That single idea rewires how you read a chart. A break of the high stops being a buy signal and becomes a question. Did that break find business on the other side? Or did it just collect orders and die? The answer shows up fast, usually inside 1 or 2 candles, and that answer is the whole strategy. Build, trap, deliver the shape of a London morning. Phase 1 is the build, and it happens while most of Europe is asleep. Through the Asian hours, the majors usually grind sideways in a narrow band. For cable, that's often 30 to 50 pips. For gold, a handful of dollars. Nothing to trade. But every hour that range holds, more orders stack outside it on both sides. Phase 2 is the trap, and it is almost always tied to the London Open. Volume arrives, spreads normalize, and price makes its first decisive move of the day straight through one side of the overnight range. Breakout traders read strength. Anyone holding the opposite side gets stopped. Both groups feed the same pool. Phase 3 is the delivery. Once the pool is drained, price closes back inside the range, and that close is the tell. The side that just broke out is now trapped, and their exits push price the other way. That is the leg with real participation behind it, and it often runs for hours. So the whole job is to sit out Phase 2 and be ready for the first candle of Phase 3. You are not predicting the trap. You are waiting for proof the trap already failed. That is the difference between guessing a top and trading a rejection. Draw the map before 8, marking the overnight range. Here is the prep, and it takes about 20 seconds. Open the 15-minute chart. Take the Asian session roughly midnight to 7 in UK time, and draw two horizontal lines, one across the highest high, one across the lowest low. That box is your map. Nothing else goes on the chart. Two practical notes. First, the UK moves between GMT and British Summer Time, so check your platform clock against London time, or you will mark the wrong 7 hours for half the year. Second, if your broker uses a New York server time, the Asian block sits in a different position on your chart. Verify it once, then it's fixed. Instrument choice matters more than people admit. This works best where London genuinely brings a step change in participation. GBP USD, Euro USD, GBP JPY, if you can handle the speed, gold, and the European indices. Skip the exotics with wide spreads. The sweep is small and the spread eats your edge before the trade starts. And not every night gives you a tradable box. If the Asian range is already twice its usual width, say cable has covered 90 pips overnight instead of 40, the move has partly happened, and there is little fuel left outside. A quick sanity check. Compare the box height to the average of the last 10 sessions. Too big, stand down. One optional extra that costs you nothing. Also mark yesterday's high and low. There are the other two obvious levels the whole market can see, so they hold orders too. If the overnight box sits just under yesterday's high, expect the sweep to reach for that instead. And if you're long, that's where your runner is going. The entry model, step by step. Take the short first. Price trades above the range high, wicks through it, and then closes back below that high on the 15-minute chart. Not touches, closes. That closes your trigger, and you enter on the open of the next candle. No hesitation. No waiting for confirmation you already have. The long is the mirror image. Price pushes below the range low, takes the stop sitting under it, and then a 15-minute candle closes back above that low. You buy the open of the following candle. Same logic, same timing window, opposite direction. The stop goes beyond the extreme of the sweep, above the wick high for a short, below the wick low for a long, plus a small buffer for spread and for the extra tick that always seems to exist. On cable, I'd add 3 to 5 pips. On gold, 30 to 50 cents. If that stop feels too wide, the answer is a smaller position, not a tighter stop. First target is the opposite side of the box, the low if you're short, the high if you're long, because the trapped orders on the other side are the natural magnet. If the hourly picture is strongly with you, take part off there and let the rest run to the next hourly level. But the trade must offer at least 2 to 1 before you take it. Just as important is what cancels the trade. If price sweeps and then simply keeps going 2 consecutive 15-minute closes beyond the level that was a real breakout, not a trap, and you stand aside. If the reclaim takes more than about an hour, the reaction has gone stale. Late entries on this pattern are bad entries. One more thing about the trigger candle, because not all reclaims are equal. The ones that work tend to have a long wick and a small body. The wick is the failed excursion. The body is the rejection. If the candle closes back inside but only barely, with a fat body and almost no wick, you're usually looking at momentum pausing rather than a trap failing. I want the close comfortably back inside the box, not sitting on the line. Worked example, 1 GBP USD, long from a swept low time. Let's walk one through with numbers so the rules become concrete. Say cable spends the Asian session between roughly 1.2712 and 1.2748, a 36 pip box, which is normal. You mark both lines and do nothing else until 8. At 10 past 8, a candle drives down to 1.2701, 11 pips through the low, and every stop parked under the overnight base is filled. The next candle closes at 1.2723, back inside the box, above the low. That close is the trigger. You buy the open of the following candle, around 1.2724. Stop goes at 1.26965 pips under the wick. That's 28 pips of risk. First target is the top of the box at 1.2748, which is 24 pips under 1-to-1. On its own, that trade fails the rules. This is exactly the moment most people either force it or skip it, and both are wrong. The fix is the hourly chart. If the H1 shows price holding above a level it broke through yesterday with higher lows into the open, then the box high is not the destination, it's a speed bump. Target the next hourly swing high instead, say 1.2795, and the same entry and stop now give you 2.5 to 1. Worked. Example 2. Gold. Short from a swept high. Gold behaves the same way with bigger numbers. Suppose the overnight range sits between 2,338 and 2,352. At the open, a candle spikes to 2,357, clears every buy stop above the figure, and closes back at 2,346, $11 off its own high, and back inside the box. Short at the next open near 2,345 with a stop at 2,358, just above the spike, $13 of risk. The range low at 2,338 is only $7 away, so again the box alone is not enough. Check the hourly. If gold has been rejecting a supply area all week and printing lower highs, the honest target is the last hourly low. Say that low sits at 2,312. $33 of reward against 13 of risk is 2.5 to 1, and now the trade qualifies. Notice what actually made it a trade. Not the sweep, the context around the sweep. The pattern gives you the entry, the hourly gives you permission. Filter 1, the hourly decides which sweep you're allowed to take. Both sides of the box will get swept eventually. Some mornings you get one sweep. Some mornings you get one at the top and another at the bottom 2 hours later. If you trade every one, you're flipping a coin with spread attached. The hourly chart tells you which one is the real reversal and which one is just noise inside a trend. The check takes 30 seconds. Open the hourly, hide everything, and answer one question. Are we making higher highs and higher lows, lower highs and lower lows, or neither? Then only take sweeps that push you in the direction that answer supports. In an hourly uptrend, you're looking for swept lows. In a downtrend, swept highs. Here's the trap inside the trap, and it costs people real money. A 15-minute chart can look perfectly bearish, while the hourly has just completed a double bottom and swept its own low. Your 15M short is textbook, and you are selling into the exact place the larger players are buying. The setup wasn't wrong. The direction was. So the hierarchy is simple, and you should say it out loud before every entry. The hourly gives direction, the 15 gives timing. When they agree, take it. When they don't, there is no trade and no amount of "but the candle was perfect" changes that. Quick one before the second filter. If this is landing, like, genuinely helps the channel put these in front of traders who need them. Right, filter 2. And this is the one people skip. Filter 2. The calendar, the clock, and the spread. This setup depends on the sweep being about liquidity. When a major data release hits, it isn't. A high-impact UK or Eurozone print can push price 50 pips through your level and keep going, because there's a genuine repricing behind it. Your reclaim never comes, and the pattern that normally works becomes a trap for you. The rule I use is blunt. Check the calendar before you mark the box. If there's a high-impact release within 15 minutes either side of your window, you don't trade that instrument that morning. One skipped setup costs you nothing. One news candle through your stop costs you a day's work. 2 more clock rules. Don't take this after about 11 in the morning UK time. By then, the London expansion is done, and what looks like a sweep is usually just chop. And treat Monday and Friday with suspicion. Monday opens with weekend gaps distorting the range. Friday afternoons drift with positions squaring. Finally, watch the spread at the open. Some brokers widen dramatically for the first minute or two, and if you mark it in during that window, you can pay several pips before the trade has done anything. Waiting for the candle close, which the rules already require, usually solves this on its own. The double sweep, when both sides get taken. There's a variation the standard version of this strategy never mentions, and once you see it, you'll notice it constantly. Price sweeps the low at the open, reclaims, runs to the top of the box, and then punches straight through the high as well before the real move begins. Both pools cleared, one after the other, in about an hour. That's awkward if you were long from the first sweep, because your target sat right where the second sweep happened, which is why I take partials at the box edge rather than hoping. Get paid where the crowd's orders are, then let a smaller runner deal with whatever comes next. The double sweep also gives you a second, often better entry. If the high gets taken and rejected too, you now have both sides cleared and a market with nothing obvious left to hunt. That's frequently where the cleanest trend day of the week starts. Same rules, same stop logic, just applied to the second failure instead of the first. No 8 o'clock? Run the same idea at the New York Open. Most people watching this have a job, and 8 in the morning is not a realistic screen time. The good news is that the mechanism isn't about London, it's about a quiet range meeting a burst of new participation. New York gives you the same thing in the afternoon, UK time. Same recipe, different box. Mark the high and low of the London lunchtime lull, then wait for the American session to push through one side and fail. It behaves slightly differently. The moves are often faster and the reversals sharper, but the logic is identical, and the hourly filter still decides which side you're allowed to take. What I wouldn't do is trade both sessions on the same instrument on the same day. That's 2 chances to be wrong on one idea, and it usually ends with the second trade being an argument with the first. Pick the window that fits your life, then learn that window properly. 4 ways traders break this setup. 1. Taking the trade because the candle looked good against the hourly. We've covered it, and it is still the #1 account killer, because the entries feel best exactly when they're most dangerous. A strong counter-trend rejection is what a pullback looks like from the inside. 2. Taking 1-to-1 targets because you want the win. A clean setup with a 1-to-1 target and a 55% win rate makes almost nothing before costs and loses money after them. Same entries, same stops, targets pushed to 2.5, and the same year becomes profitable. The maths does the work, not the wins. 3. Trading every sweep the day gives you. Revenge is subtle here. You lose the 8:15 trade, the low gets swept at 10, and it genuinely looks valid. Give yourself a hard rule: 1 trade per instrument per morning. If it loses, you're done on that chart until tomorrow. 4. Moving the stop once you're in. The whole premise is that the wick marked the extreme. If price returns there, the premise is dead and you want to be out. Widening the stop turns a small planned loss into the kind that changes how you trade for a week. Set it, then leave it alone. The maths that makes a normal win rate work. Risk a fixed 1 to 2% of the account per trade, fixed as a percentage, so position size changes with the stop distance rather than the stop changing to fit a lot size you like. On a £10,000 account, at 1%, that's £100 of risk, whether the stop is 12 pips or 28. Now, the expectancy. Take 20 trades at 1% risk with a 2.5-to-1 average payoff. Win 8, lose 12, and you are up 8%. 8 wins at 2.5% is 20. 12 losses is 12. A 40% win rate is a good year. That should change how a losing streak feels. Because you will get 4 losers in a row on this, not might will, at a 40% win rate that happens regularly, and it means nothing about the strategy. What it does mean is that if you're risking 5% a trade to speed things up, a normal run of losses takes a fifth of your account. One cost people forget: the spread and commission come out of every single trade, win or lose. If you're risking 28 pips to make 70 and paying 1.5 pips round trip, that's roughly 5% of your edge gone before you start. It's survivable at 2.5 to 1. It is not survivable at 1 to 1, which is the real reason small targets quietly kill accounts. Your next 20 sessions. How to actually learn this. Don't take this live tomorrow. Do this instead. Open the 15-minute chart on one pair. Scroll back 20 trading days and mark the overnight box for each one. 20 boxes, 10 minutes of work. Then for each session, write 4 things. Did a side get swept? Did price reclaim the level within an hour? What did the hourly say at the time? And what would the trade have returned in R? 4 columns, 20 rows. That spreadsheet will teach you more than another 10 strategy videos, mine included. 2 patterns will jump out. You'll find the pair that respects the box on your broker's feed, and you'll find the time of morning it happens most often for that pair. That's not information you can get from a video. It comes from your own 20 rows, and it's the part that makes the strategy yours. After the 20 rows, 4 test it live, but tiny, the smallest size your broker allows, for 2 weeks. Not because the money matters, but because clicking under real conditions is a completely different skill from marking boxes on history. Scale up only when your live results look like your backtest results. Recap and next steps. So, the whole thing in 5 lines. Mark the overnight high and low on the 15-minute chart. Wait for London to push through one side and close back inside. Enter on the next candle. Stop beyond the wick plus a buffer. Target the far side and beyond, only in the direction the hourly supports. Never when high-impact news is due. And remember the order of operations, because it's what separates people who make this work from people who collect screenshots of it. Context first, then pattern, then risk, then execution. Get those backwards, and even a perfect entry is just a coin flip with extra steps. If you want the next piece of this, how to read the hourly bias in under a minute, which is the filter doing most of the heavy lifting here, that breakdown is coming next. Subscribe and turn on the bell so it lands in front of you. And tell me in the comments which pair you're going to run the 20-session drill on. One last thing, and it matters more than the setup. Nothing here is financial advice. Trading carries real risk, and you can lose more than you expect. Keep your risk at 1 to 2% per trade. Test everything on your own data and trade a version of this that you've proven to yourself. See you in the next one.